Good morning. Welcome to ICG Enterprise Trust's half-year results for the 6 months to 31st of July 2024. I'm joined today by Oliver Gardy and Colin Walsh, who will discuss our investment performance and activity in more detail over the course of this presentation. The slides for the presentation, along with the accompanying results announcement, are available on our website. We will have time for Q&A at the end of the presentation, so if you'd like to submit a question, please do so through the online portal at any point in the Q&A box on your screens. We will then aim to answer those questions at the end of the session. With that, Oliver, over to you.
Thanks, Martin, and good morning, everyone. I thought it makes sense to kick off the presentation with a quick reminder of our investment strategy and what we're actually trying to achieve for our investors. In summary, we're trying to provide our investors with top-tier private equity returns, but with less risk and more liquidity. And this slide is really our guide for strong risk-adjusted returns. And let me explain a little bit more in detail. As many of you are aware, private equity has a long-term track record of outperforming public markets. And our strategy, as outlined on the slide, is about maximizing our returns while simultaneously managing risk. So how do we do this? First of all, we only invest in buyouts. Why? Because more mature companies which have a more consistent return profile, and we do not invest in venture capital or growth equity, which can have loss rates of 60 to 75%, whereas for buyouts, it is around 10%. So it's a completely different risk profile. We only invest in developed markets, not Asia or emerging markets, only North America and Europe. Because these geographies have a more mature private equity market with very deep knowledge, expertise, and strong pipeline of quality managers and deals. We invest only in mid-market and larger deals, funds typically over 1 billion in size. And they have the necessary investing experience, team, resources to deliver what makes private equity perform better than other asset classes. We look for funds that have the resources, the operational capacity to source good companies and then to transform them into market leaders. Furthermore, we invest only in top-tier managers. As many of you are aware, the dispersion between a top quartile fund and a bottom quartile fund is larger in private equity than in any other asset class. Therefore, picking the right managers and funds is especially important in private equity. We have a long demonstrable track record for over 40 years in picking top-tier funds. Finally, we look for managers and companies that are aligned with our defensive growth theme, focused on companies and sectors where performance is not cyclical or seasonal, but not so defensive that there is very limited growth potential. So we are looking for companies with good growth potential, but are just non-cyclical. Now, important on the slide are the three little circles all the way on the right-hand side. And this is about our fund selection process. In addition to the fund selection process, we have the ability to outsize returns by making discretionary investments and actively construct our portfolio. We invest 50% directly in secondaries and co-investments alongside our fund managers. Which brings me to the next slide. And you'll see here the 50-50 split between fund investments and direct investments or discretionary investments, as well as having a dedicated investment team. And this allows us to actively construct and diversify a portfolio of companies which are market leaders in their sectors and have defensive growth characteristics. By geography, we aim 50-50, North America and Europe. And by sector, we do not pursue a sector-specific investment strategy. However, we look for sectors with defensive growth characteristics like software or subscription-based businesses. Our top 3 sectors in our portfolio are well spread across technology, consumer, and business services. Noteworthy to flag, technology was 24% of our portfolio last year, and it is now 29% of our portfolio and 34% of our top 30. And we will talk later about this in the presentation, but this is one of the reasons for continuing strength of our valuation multiple. Towards the bottom of the slide, we list out our top 5 underlying company exposures. Many of you will be very familiar with many of these. Colin will talk later of the new entrant to this list, which is DataSite, But overall, you can see a top 5 spread across country and sector, all benefiting from long-term structural growth trends in areas such as digital transformation and tech-enabled business services. Quick reminder, the top 10 portfolio companies represent 19% of our portfolio, top 30 represent 40%, and top 50 represent 50%. We're happy with the construction and diversity of the portfolio, and we believe it positions us well to deliver attractive returns for our shareholders. On the next slide, you see our active portfolio construction has translated to an LTM NAV per share total return of 4% to the July 31st, 2024. Private equity, as I said before, is a long-term asset class, and looking for the longer term, you can see from the slide our NAV per share total return and our share price total return over 3 to 5 and 10 year are all double digit and all outperformed the FTSE All-Share Index total return. As a reminder, all our performance figures are reported net of fees and cost. Some observations. Let's turn specifically now to our H1 results. This is a 6-month period maintaining our momentum, with our portfolio companies continuing to grow revenue and EBITDA, with LTM earnings growth about 14%. There's also a strong quarter-on-quarter upward growth trajectory from Q1 to Q2, with Q1 growing 0.5% on a local currency basis and Q2 growing at a strong 3.2%. In terms of activity, very contrasting years for private equity activity levels between 2021 and 2022, which saw very high activity. And then in 2023, we saw very low activity. We would characterize the start of 2024, which is what this period reflects essentially, as a period of trending back to normalization. We're experiencing an increased level of transaction activity. Our portfolio companies are realized and we're generating meaningful value. We had 9 full exits in the period that were realized at a weighted average uplift carrying value of 26%. Our focus on the wider shareholder experience is yielding benefits. The volatility of our share price has reduced. Trading liquidity has increased over the last 5 years. And finally, we welcome the recent announcement by the FCA regarding costs and are reviewing our disclosures. Let's put the half year into numbers. Our portfolio grew on a local currency basis by 3.8%, and most of the growth came in from the second quarter, and on a sterling basis by 2.6%. That translated our NAV per share total return of 2.8% and a share price total return of 10.3% in the 6 months to the 31st of July. And as you can see on the top right of the slide, 33 million was returned to shareholders in the period, split approximately 1/3 in dividends, 2/3 in buybacks, and we intend to continue both these mechanisms on a long-term basis. Finally, the 6-month period saw the net investment by 18 million, with investments 104 million and proceeds of 86 million, which Colm will talk in more detail. Moving on to the next slide. This slide outlines some of the key operational and financial metrics of our underlying portfolio. The top row represents our top 30 companies, which is about 40% of our portfolio, and the bottom row, our enlarged data set, representing nearly 2/3 of our portfolio, where you can see 9.4% LTM revenue growth and 13.9% LTM EBITDA growth. This has moderated down marginally, but in a sense reflects the absence now of the COVID rebound and our very strong growth figures, in particular if you compare it to the GDP growth or to the FTSE S&P 500 average. On valuation metrics, the weighted average EV/EBITDA multiple increased to 14.9 across our large perimeter, and with average debt marginally down at 4.4x. This reflects the quality of our underlying portfolio companies and prudent debt levels. You will see the valuation multiple of our top 30 companies has gone up from 14.6 to 15.3, and this increase is caused by mainly the inclusion of Chewy, which is now a very profitable business and being valued on the EV/EBITDA metrics we usually use for the top 30. Secondly, due to the increasing tech exposure of our top 30, now 33% compared to 27% of our top 30 by value as of the 31st of July. And then lastly, the overall rise in valuation in the public equities market and the high quality of earnings of our portfolio companies caused some of that increase. And with that opening, I'll pass to Colm to discuss our H1 activity more specifically.
Fantastic. Thanks, Oliver, and good morning, everyone. So in the next few slides, we're going to take a look at what happened, as Oliver was saying, over the last 6 months in the portfolio. I'm sure none of you need reminding, a period of continued market adjustment and heightened geopolitical risks. As a reminder, we like to break down the investment cycle into 4 phases, and I'm going to update you in each aspect of that cycle. Just to give you an overview, first phase, we make commitments to new funds, we're called for capital, and then or we invest directly into portfolio companies. Then typically, that's our new investments, then typically between years 4 and 8 in the fund life cycle, our managers get to work adding value. That's, if you like, the kind of the growth phase. And finally, and most importantly, selling the businesses, typically to strategic buyers or to other financial buyers. And the cycle continuously repeats. So as realizations come in, our cash balance will increase, and we redeploy those proceeds into new commitments and investments. Now, I said 6 months ago in our full year results that the cogs in the machine were turning a little slower in 2023. And if I carry that analogy forward to today, the engine, as Oliver was saying, is beginning to pick up a little bit of pace, but we're far from being at full throttle. And we can see that in the global buyout market. Volumes are annualizing at similar levels to 2023, but we can see pickup and some momentum in recent quarters. We care about this higher activity, as higher transaction activity obviously gives you investors confidence in our valuations. And as well as that, realizations help to boost our NAV growth, given the history of uplifts on exit, which I'll cover in a later slide. We remain optimistic about those transaction volumes, particularly given some very positive news following recent rate cuts. Moving on to the next slide, looking at our new commitment activity. We made £72 million worth of new fund commitments over the half year. The largest was to an ICG strategy, strategic equity. This is our GP-led secondary strategy. ICG are pioneers in this space, and the $25 million commitment aligns with our target allocation for secondaries, which you've already seen. And we also committed to Leeds Equity, Invest Industrial, Oak Hill, and Thoma Bravo. They are all well-established managers, and in each case, we already have long-standing relationships with them. So just to give you a little bit of colour on one of those manager relationships, moving on to the next slide. I'd like to talk about Oak Hill. Oak Hill, it was one of our first US managers when we decided to start investing in the US back in 2016. It's a long-standing manager with roots dating back to 1986. And we've made commitments of over $50 million since we commenced our US investment program to Oak Hill funds. The latest of which you saw from the previous slide, was a $15 million commitment to Oak Hill 6. We've also successfully co-invested alongside Oak Hill in a business called Berlin Packaging, which you may recall. That was a highly successful exit for us with a strong money multiple and IRR performance. Now, Oak Hill, in our view, is a top-tier manager. It's got a strong track record, and it's got a very good history of returning capital to investors quickly. As a reminder, this is very important for an evergreen fund like ICG Enterprise, as funds which offer that strong IRR performance help to optimize NAV growth. One full exit which occurred this period was an Oak Hill holding, one of the last in the fund, a business called SafeFleet, which is a provider of safety products for fleet vehicles. This actually makes Oak Hill 4, a fund we committed to in 2017, almost fully realized. But that's not bad for a commitment which we made a little over 7 years ago. Moving on to the next slide and turning our attention to new investments in the period. During the period, we invested £104 million, a relatively low volume, which is consistent with trends in the broader market. Just to pick on two notable examples of new investments in the period, DataSite was our largest investment. We invested £25 million in the period, alongside ICG Strategic Equity and their partner CapVest. And as Oliver noted earlier, that's a new entrant into our top 10 investments. It's a provider of software as a service, or in the jargon, SaaS software, focusing on virtual data rooms. We believe it's an attractive, high quality, typical, great exemplar of a defensive growth business. And very importantly, it's one where ICG has significant institutional knowledge. Many of you will also know Visma, the largest provider of European, again, to use the jargon, SaaS, enterprise resource planning software. This was our second largest investment in the period. It's a co-investment alongside HG Capital. It has, again, typical for many of our larger exposures, a leading position in its market, really strong secular growth trends, and very consistent revenue and EBITDA growth track record. It also has a very highly experienced management team and a sponsor which has particular domain expertise. Moving on to the next slide, where we discuss portfolio performance. Our portfolio this period grew by 3.8% on a local currency basis, and this was spread across primary, secondary, and direct investments. And that performance was overwhelmingly skewed to the second quarter. The direct portion of our portfolio marginally outperformed. Companies that did particularly well include Davis Group and Chewy. Chewy's listed companies, that was a reflection of share price performance. And Davis Group, as a reminder, is a supplier of insurance claims outsourcing services. Definitely not a household name, but again, another example of one of our larger investments, which has a leading position in its sector. There was some FX headwind in the period. The sterling appreciated against the US dollar and euro, and we therefore ended the period with a portfolio value of just over 1.4 billion as at the 31st of July 2024. Moving on now to the final phase, realizations. Just like new investments, reflecting slightly lower transaction volumes, but as Oliver noted, where we're definitely seeing some momentum. Realizations in the period totaled 86 million. If we split it out by quarter, as you can see on the chart, the trajectory is clearly upward. So you can see Q2 this year was notably higher. You can see Q2 this year was notably higher than Q1, and also compares very well to some of the recent historical quarters. To put numbers on that, Q2 this year, so that's the months of May, June, and July, we saw around £60 million worth of realizations, whereas the 4 quarters before that were hovering around £30 million worth of realizations for each quarter. Some of the exits this period are shown by the logos on the right. Just to pick on the top 3, Vetifi is a provider of financial indices and data. That was an investment alongside our colleagues at ICG Strategic Equity, so that GP-led secondary strategy. Visma and DataSite, you can actually see are on both lists of new investments and largest realizations. This reflects where companies have been recapped and where we've opted to reinvest the proceeds we've had from those transactions. We like, obviously, investing in companies where we have strong institutional knowledge and where there's a really clear ICG edge. And we believe that's the case with both of those companies. So we decided to elect part of our proceeds. Moving on to the next slide. Touched on this earlier. As we talk about realizations, I wanted to review our performance on exit. And obviously, the best proof point for any valuation is what a company sells for when it's ultimately exited. In the period, we had 9 full exits at a weighted average uplift to carrying value of 26%. And that continues a long-term trend of realizing exits at a material premium to their previous carrying value. And worth noting too that these exits have also crystallized strong returns, so averaging 3.1 times money, 3 times 1 on cost. This performance and this track record demonstrates the quality of our investments as we continue to generate meaningful value across the portfolio. Moving on to the next slide, where I'd just like to spend some time on capital allocation. which remains a very important component of the wider shareholder experience. ICG Enterprise Trust has a long-standing progressive dividend policy, which you can see on chart number 1 here. A long-term share buyback program, which we instituted in 2022. And during the period, the board introduced an opportunistic buyback program to take advantage of current trading and discount levels, where the opportunity to purchase shares in meaningful size and at a significant discount presents itself. All three combined and inclusive of the intended FY25 dividend of at least 35 pence a share, that totals £48 million, which is equivalent to nearly 4% of opening NAV. We believe that these measures demonstrate our holistic approach to optimizing returns for our shareholders, and it's also delivered on its aims of reducing volatility in the share price and improving trading liquidity. And finally, and before we move on to some Q&A, just some takeaways that we wanted to leave you with from this set of results. So firstly, our portfolio is continuing to grow. We continue to deliver long-term defensive growth despite a low transaction environment and despite that backdrop of ever-increasing geopolitical risk. We are seeing an increased level of transaction activity, and we're hopeful that the conditions are in place to return to more normal volumes, given an improved macroeconomic outlook and given recent rate cuts. And finally, we're continuing to implement our capital allocation policy to optimize the shareholder experience, to better align our portfolio and share price performance.